Dirty dealings, corporate battles, consumer woes. This is Evening 5. YTL Power International said the Malaysian Anti-Corruption Commission has cleared the group's 60% owned subsidiary, YTL Communications, of any wrongdoing in connection with the 1BestariNet project. In a BOS filing, YTL Power said it was informed of this by MACC after concluding an investigation into the multi-billion ringgit project undertaken by YTL Comms. MACC determined that no charges will be pursued against YTL Comms. On September 4th, Bernama, citing a source, reported that MACC had launched an investigation into payment claims related to the 1BestariNet service tender and that the graftbuster raided several government offices as well as the office of YTL Comms. According to the report, the investigation was centered on claims involving false details related to 2.7 billion in payments as well as other criminal elements under the MACC Act 2009. YTL Power had previously said that the 1BestariNet project was awarded to YTL Comms in 2011 by the Ministry of Education following an open tender involving 19 companies that tendered bids for the project. YTL Comms was selected for being the most technically compliant and most cost-effective bid. The 1BestariNet project entailed a 15-year service contract to provide internet connectivity to 10,000 schools nationwide in phases. YTL Comms, however, only undertook the first 2 phases of the 15-year project, which included in end June 2019. The following month, YTL Comms claimed that the MOE had breached its contractual obligations after it appointed Telekom Malaysia, Celcom Axiata and Maxis as providers of interim internet services for the remaining second half of 2019 when YTL Comms had offered to do so for free. The company insisted that it had a legitimate expectation to be granted an extension of the contract after having allegedly invested over 4 billion ringgit into the schools for the project. EcoWorld Development Group, in collaboration with ST Guthrie and Negeri Sembilan State Investment Arm NS Corporation, will jointly develop a 1,166-acre industrial park in Bukit Pelanduk, Negeri Sembilan that will have an estimated gross development value of 2.95 billion ringgit. To be developed over 8 years, the project will have industrial lots, ready-built factories and commercial properties that will cater to high-growth sectors such as aerospace, electrical and electronics, logistics and biotechnology, according to the joint statement. The industrial park will be situated within the Malaysia Vision Valley 2.0 economic corridor and form part of a larger initiative to advance sustainable development in Negeri Sembilan. ST Guthrie is the world's largest palm oil producer by acreage and is also one of the largest landowners in Malaysia. In Negeri Sembilan alone, the group operates 16 estates, 3 palm oil mills and 2 biogas plants. ST Guthrie MD Datuk Muhammad Helmi Othman Basha says that the group is well positioned to support Negeri Sembilan's development ambitions. EcoWorld, meanwhile, holds close to 9,000 acres of land bank across the Klang Valley, Penang and Iskandar, Malaysia, with an estimated GDV of 86 billion ringgit. A significant portion of EcoWorld's land bank, 2,415 acres, is dedicated to industrial parks. EcoWorld President and CEO Datuk Chang Kim Wah says that the group caters to a diverse range of industries and offer tailored solutions to meet the evolving demands of today's dynamic industries and is confident that this initiative will bring new business opportunities. Negeri Sembilan MB Datuk Seri Aminuddin Harun says the Bukit Pelanduk project reflects the state's vision to become prosperous, inclusive and sustainable by 2045. Malaysian Resources Corp has withdrawn from the Berjaya-led consortium bidding for the multi-billion ringgit Kuala Lumpur-Singapore high-speed rail project, according to Berjaya Group. MRCB's decision to exit is to pursue other strategic opportunities, according to Berjaya's statement on Wednesday. MRCB did not respond to the Edge's queries as at time of this recording. Berjaya Corp founder and advisor Tan Sri Vincent Tan Chi Yun said that the group remains steadfast in its mission to deliver a world-class HSR system that will transform regional connectivity and economic development for Malaysia and help its successful transition towards green mobility. With MRCB's departure, the consortium comprises Berjaya Land 70% owned Berjaya Rail, government-owned Keretapi Tanah Melayu, IJM Corp and technical partners Deutsche Bahn, Hitachi Rail and Hyundai Rotem. The remaining 30% of Berjaya Rail is owned by Johor Princess Tunku Tun Aminah Sultan Ibrahim, the only daughter of Malaysia's King Sultan Ibrahim. According to B Corp's latest annual report, Tun Amina is also chairman of Berjaya Rail. According to reports back in March, the Berjaya-led consortium were among the 3 consortia shortlisted. The other 2 were a YTL Construction SIPP Rail Consortium and a Chinese consortium said to be led by state-owned China Railway Consortium. This was after MRCH Corp's request for information exercise for the project closed in January this year. Since then, the project has been in limbo pending the green light from the government. The proposed abolition of the Rule of 78 by Bank Negara could pave the way for similar reforms in other financing products, including hire purchases, having a larger impact on the banking sector, according to Phillip Capital. The Rule of 78, a widely used method that front-loads interest charges on personal financing products, requires borrowers to pay a higher proportion of the interest early in the loan tenure. While this benefits banks in the short term by ensuring they collect more interest upfront, it discourages early loan repayments as borrowers stand to save little on interest if they settle their loans early. However, the potential removal of this method, banks could face new challenges, said Phillip Capital in a note. Without the front-loaded interest income, they may see an increase in early repayments, leading to higher portfolio turnover. It added, the shift could force banks to redeploy funds into lower-yielding assets, increasing reinvestment risks. To mitigate this, banks may look to raise their effective interest rates, which could offset some of the lost interest. Phillip Capital said the net effect on interest income could still be positive. The research house also noted that shifting to a variable rate personal financing loan would allow banks to benefit from a rising interest rate environment, helping to maintain profitability despite changes in loan structure. Among banks, Alliance Bank Malaysia holds the largest exposure to personal financing products at 11% of its portfolio, followed by Affin Bank, CIMB Group Holdings and RHB Bank, each with 6%. Globally, the Rule of 78 has come under fire for being unfair to borrowers, and its removal is seen as a step forward in consumer protection, said Phillip Capital. If implemented, it added, this change could pave the way for similar reforms in other consumer financing products, such as hire purchase loans, potentially having an even broader impact on the banking sector. Packaging manufacturer and developer Scientex saw its first quarter FY 2025 earnings slip 6.7% year-on-year to 128.6 million as its packaging segment's lower profits more than offset the better performance of its property division. Revenue was flat at 1.11 billion as the growth recorded by its property division was partly offset by the decline in its packaging revenue due to unfavorable foreign exchange movement and softer demand from the export market. In a separate statement, Scientex Managing Director and Chief Executive Officer Lim Peng Jin said the group's property division continues to benefit from robust demand for affordable homes. He said that by focusing on strategically located projects and expanding its portfolio of quality, cost-effective homes, they are able to meet market demand while improving housing accessibility. As for its packaging segment, Lim highlighted that the division would focus on innovation, operational efficiency enhancement and sustainability to navigate through a challenging global economic environment. On prospects for its property division, Lim said the group targets to launch 8,000 affordable homes annually starting in FY 2025, up from 6,300 units in FY 2024. This aligns with its goal of delivering 50,000 affordable homes by 2028. Currently, it has completed nearly 38,000 homes. As for its packaging segment's prospects, Lim says that while the global packaging market remains subdued due to ongoing supply chain disruptions and geopolitical tensions, the demand for flexible packaging persists given its essential role in everyday activities.